Hello, my name is Doug Greenberg, and I'm the president of Pacific Northwest Advisory, and this is February's 5 Slides in 5 Minutes. As an everyday American investor, you might be interested to know that there's a positive shift happening in the investment landscape. Recently, both US and global equity funds have begun to see inflows of capital, meaning more money is being invested into these funds than is being withdrawn. This is tracked on a rolling 3-month basis and is typically seen as a positive or bullish indicator for the stock market. It suggests that investors are becoming more confident and are starting to jump on the bullish bandwagon. This kind of movement can create a self-reinforcing effect where the increasing inflow of funds can push stock prices higher, which in turn may attract more investors wanting to take advantage of the rising market. This trend could point towards a potential opportunity for growth in your investments. However, it's important to approach such trends with caution, as bandwagoning can sometimes lead to overvalued markets. It's always a good idea to make sure your investment decisions align with your long-term financial goals and risk tolerance and not just the prevailing market sentiment. The recent surge in capital expenditures, or CapEx, outlined in the 2024 macroeconomic outlook offers an intriguing snapshot of where the economy might be heading. In the US, significant investments have been made in factories and buildings, spurred by government incentives through the CHIPS and Inflation Reduction Act, which aim to strengthen domestic industry and research and development. With an emphasis on clean energy and geopolitical strategy, this trend of reshoring is mirrored in Japan's high-tech manufacturing sector, where factory construction has also increased, possibly benefiting from geopolitical shifts. Additionally, there's been a noticeable rise in defense spending across Europe and the US, and more broadly, a general uptick in corporate capex, especially from technology and traditional cyclical sectors. A key part of this investment boom is the global push towards renewables and alternative energy, which in turn has driven up investment in industrial metals and mining. While these investment trends represent long-term strategic shifts and are interconnected with the larger economic picture, including uncertainties, rising borrowing costs, and tighter lending standards, they paint a picture of a world adapting to technological advancements and changing geopolitical and sociopolitical landscapes. For investors, these trends could signal opportunities in sectors that are receiving heavy investment and could benefit from these global shifts. Although caution is warranted, given the potential difficulty in maintaining such high levels of investment growth into 2024. It's essential to consider how these macroeconomic factors might influence your investment decisions and to maintain a diversified portfolio to navigate the changing economic cycles. In recent developments that are sure to capture the attention of the American investor, the Fund Manager Survey, or FMS, has reported a significant shift in investor sentiment. For the first time in over a year since April of 2022, those who surveyed are not forecasting an economic recession. This is a marked change from previous months where concerns about a downturn were prevalent. Adding to this positive shift, there is a renewed sense of optimism regarding global economic growth, which hasn't been this high since February of 2022. What this means for everyday investors is twofold. First, the investment climate may be perceived as less risky than it has been in recent months, potentially opening up opportunities for portfolio growth. Second, the heightened optimism could lead to increased market confidence, which may result in a more favorable environment for both equity and bond markets. However, it is important to remember that market conditions can change rapidly, and while the current outlook is optimistic, investors should continue to make decisions based on their individual financial goals, time horizons, and risk tolerance, ideally with the guidance of a financial advisor. The remarkable surge in the influence of the Magnificent Seven, a group of leading technology firms, underscores a significant trend in the US stock market that's been especially pronounced since the start of 2020. These companies have not only dominated earnings growth, tripling their earnings per share in a period where the broader market, excluding these tech giants, saw a modest 25% increase, but they have also become notably more expensive for investors. This concentration of market power and value in a small group of companies raises important considerations for the average American investor. While the robust performance of these tech giants has been a key driver of overall market returns, their high valuation means they carry a higher risk and could potentially lead to greater market volatility. Furthermore, this concentration may limit the diversification benefits traditionally sought by investors to manage risk in their portfolios. Understanding this dynamic is crucial, especially in the context of historical comparisons. For instance, the market concentration today is far more pronounced than in 1995, a time when the Dow reaching 5,000 was a milestone. Investors should weigh the potential rewards of investing in these high-performing but expensive stocks against the risks of increased concentration and reduced diversification in their investment strategies. For investors, particularly those concerned with earnings per share growth, or EPS growth, here's a crucial insight. The current landscape shows a notable difference between the performance of the top 7 companies, the Mag 7, and the bottom 493 stocks in the S&P 500. However, there's a promising trend on the horizon. Analysts project that while the gap in earnings growth is expected to persist in the first quarter, significant changes are anticipated thereafter. By the second quarter, earnings growth for the Mag 7 is predicted to surge by 20%, outpacing the 493's 8% growth. This trend is forecasted to continue, with the gap narrowing in the third quarter and potentially reversing in the fourth quarter, favoring the bottom 493 companies. This shift might lead to a rotation of investment focus into the 493, as their earnings growth could outpace that of the Mag 7 by the fourth quarter. Stay informed and keep an eye on these developments as they unfold. Thank you for listening, and if you have any questions, please let me know.